From New York City for our viewers worldwide, I'm Lisa Abramowicz in for Jonathan Ferro, with green actually on the screen, with a sense that maybe we've got calm in the bonds that can let stocks to take over. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Coming up, stocks looking to snap their longest losing streak of the year. Earnings season ramping up with big tech results from Microsoft and Alphabet, and House Republicans planning another vote to elect a new speaker. We begin with the big issue, whipsawed by bonds.
You know, the first thing I do when I wake up in the morning and to get a barometer on the markets is look at the 10-year.
A lot of this is whipsawed.
We've seen the 10-year move up so rapidly.
Fundamental technical elements have driven yields beyond where they probably should be.
There's so many different forces which are buffeting the bond space.
Challenge in the bond market.
We're finally seeing supply come in and really scare those bond vigilantes.
Geopolitical risk like this, you know, they make investors really uneasy.
Yields are higher. They're probably staying here for longer, but you know, the economy continues to do well.
So far as central banks are concerned,
the bond market is helping the Fed slow the economy.
The rising bond yields that we've seen is doing some of their work for them.
These high levels of uncertainty have unfortunately become a new normal.
We're looking for rate stability.
We're in a time of dislocation in bonds.
What you do is you've got to get through
it. Joining us now to discuss how to get through it is Morgan Stanley's Andrew Sliman and Bob Elliott of Unlimited. Bob, I want to start with you. How much has the whipsawed action in bonds made it incredibly difficult to make any kind of investment, regardless of whether it's in bonds or stocks?
I think a lot of the bond volatility that we're seeing in the short term is driving this sort of day-to-day chop, that idea that the first thing you look at in the morning to understand what's going to go cross-asset, what's happening cross-asset, is you look at the bond market. I think in general, though, if we take a step back, we've had a pretty big adjustment in bond yields, you know, more than 100 basis points over the course of a couple of months. And we're starting to see in that market a bit of stability as yield-sensitive buyers are coming in, starting to cap the rises in yields and able to, you know, give enough demand in the market to help meet that increased supply from the government issuance coming up.
How much, Andrew, are you sort of putting on ice a lot of your bets just to understand where bonds settle in?
Well, yeah, I've been calling for the fourth quarter rally. I thought earnings were going to come in strong, but the speed with which rates have gone up, you know, has gotten me nervous. Now, if you look what happened yesterday, the futures were indicated down. Bond yields peaked and then came down, and that reversed the market. And yet, today, settling in below 5% on the 10-year, you have futures up again. So clearly, as Bob said, it is the bond volatility driving the market. And if we can get the bond market to calm down, I do believe we can get a lift out of other things that affect the stock market, like earnings.
Before we get to earnings, and we're going to get there, Bob, I want to pick up on your point about what's driving some of the increase in yields and the volatility. Peter Shear of Academy Securities pointing the finger at Washington, writing, quote, "The recent moves in yields have almost nothing to do with the Fed and everything to do with fiscal policy. The 10-year Treasury almost pierced 5% because no one knows what D.C. is going to do, and what we can surmise is not good." Bob, how much does this change your feeling on a broader level, just about bonds as a haven asset, and pushes you toward other asset classes?
Well, I think a lot of the repricing of the increased supply in bonds has mostly happened. And when I look across assets, the biggest question I'm looking at is what other assets are out there are not reflecting the meaningful rise in term premiums that we've seen, the meaningful rise in bond yields. You know, if you think about bonds, particularly on the long end, they've fallen about 50% from peak. And you look across assets, for instance, stocks that remain just off highs. So if I'm thinking about which assets are overvalued in this market, it sure isn't bonds. It's much more stocks, not bonds.
Andrew, want to comment on that?
Yeah, I mean, overvaluation, undervaluation is all predicated on the ability of Wall Street to predict what's going to happen in the future. I think I've been on Wall Street 36 years, and that's the biggest error I see. If you wind the clock back 6 months and said the mega cap tech stocks were overvalued, the reality is their earnings estimates are up for this year have been revised up by over 20%. So be careful when people talk about overvaluation, undervaluation, because it's the assumption that they've got their earnings outlook correct. And the reality is, for the biggest of the big stocks that drive the S&P, people have been wrong. Analysts have been wrong. They've been too pessimistic. Likewise, when people say the equated is cheap, well, most stocks, actually, estimates have come down a little bit. So the S&P equated hasn't looked as cheap because the E has been a little bit too high versus the S&P cap weighted, it's been too low. So I'm very wary. I'm more interested in what's going on revisions, and that's why tonight's reports are very, very important.
Bobby, you want to respond?
Well, I think the main question is what is priced into the equity markets on the earnings side. And when you look at bottoms up analyst estimates over the course of 24 and 25, the expectations are for a 25% increase in earnings. Now, how is that going to transpire? Even in the best of circumstances, we're looking at 5 or 6% GDP growth. So, and we already have margins that are extremely elevated relative to history in an environment of tight labor markets. And so how do you add up how do you get from a macro perspective down the sort of earnings that are priced into the market just at a time when we've had this additional 100 basis points of long end tightening in the market? Those are the sorts of conditions that typically align with nearer term softening, not nearer term strong earnings growth.
Which is the reason why everyone is looking at earnings, and that really is taking the center stage today. Markets certainly on edge. Ahead of big tech earnings later today, Alphabet and Microsoft reporting after the closing bell. Bloomberg's Katie Greifeld joining us now for more. Katie.
Well, this is today. The biggest earnings week starts today, and it's headlined by big tech, kicking off with Microsoft and Alphabet tonight after the close, as you said. And that starts really 164 companies worth nearly 16 trillion rather in market cap in the coming days. And there's little room for error here, Lisa. These big rallies in these big mega cap tech stocks, they've powered the bulk of the S&P 500, still 10% year-to-date gain. You take out those top 7 names, the S&P 500 is actually lower on the year. And now that run-up has stalled over the past couple weeks, as you can see in that chart. So that really puts tonight's results and the coming days under a microscope. Really, investors are looking for a reason to restart this rally, or at least justify the gains that we've seen year-to-date. But they're reporting into a pretty punishing environment. It's still early, but Bloomberg intelligence data shows that companies that have missed profits so far this season have underperformed the benchmark by 3.7% the following day. That is the worst showing since at least 2019. So we'll see how the next couple of days goes.
Katie Greifeld, thank you so much. Great work as always. To that exact point, Andrew Slimman, Bob Elliott, you're both with us. Andrew, from your vantage point, does that make you concerned that the stocks, even that beat, are not getting received that well in the equity market?
No, I mean, the setup going into earnings is actually pretty good right now, which is the market's been weak. And so we're focused on something other than earnings. What worries me the most is when the market is red hot going into earnings season and we're talking about the whisper number being higher than expected. So, yes, I get the fact that when companies miss, stocks go down. They should go down. That's no surprise to me. But I do like the setup into this earnings season. Stock market's been weak. We're focused on something other than earnings, and that tends to be a pretty good setup.
Bob, what are you looking for to understand whether things are completely mispriced in the equity space and whether earnings can really keep up? Is it also revisions akin to what Andrew was talking about?
Yeah, I think the main question, just going back to that point around the bottoms-up analyst expectations, looking for that 25% earnings growth over the next 2 years, we basically I'm mostly focused on how are companies projecting how they're going to reach those sort of expectations. And I think that's really where the disappointment is likely to set in. On a backward-looking basis, over the quarter, nominal GDP growth has been pretty strong. We're likely to see, decent earnings, not great, but pretty good earnings as a function of that. But really the question is looking ahead and how are these companies going to justify what the elevated expectations are in the market for their earnings growth. And I think that that dynamic that you're seeing in the market that Katie Greifeld highlighted is indicative of the fact of how elevated those expectations are and how fragile the equity market is if those earnings come in below what people are expecting.
Bob, is it easier or harder to just focus on big tech away from the other names that are not showing the same kind of strength and have actually had a pretty poor year?
Yeah, well, for most investors, it doesn't really matter whether it's big tech or the little companies. They hold a market cap weighted portfolio. And so you've got to take the S&P 500 as it exists, as a combination, as the total market cap. And so I think in many ways, it's more effective to be trading these markets from a top-down perspective, looking at the market cap weighted basket rather than trying to pick out the particular stocks, because it's really the market cap weighted baskets where you're seeing the huge cross-asset divergences between the significant repricing in the bond market and the lack of repricing in the equity market.
Andrew, from your perspective, are you doing the same thing, trying to compare things on a sort of top-down level? Or do you think, given the dominance of some of these players and some of the narratives, that it's not actually apples to apples in the same kind of way anymore?
Well, yeah, I mean, I think you got to look at actually bottom-up fundamental revisions. And what Bob's talking about of 25% over the next 2 years, that's 12% for next year. And the reason why it looks so juicy is that this year we have had flat year over year, so the comparisons get very easy next year. That's the reason why it looks so good. But what I struggle with a little bit is, well, how can you have 12% earnings growth and the expectation in the bond market that the Fed is going to be cutting rates next year? I don't think those things make sense. So there's a disconnect there. One of those is wrong. Either we're not going to have 12% earnings growth, or the Fed's not going to be cutting next year. And so getting back to your question, it all leads back to what are the companies that are doing the best, where they are exceeding outlooks, they're doing better. I think that's where you get the most likely strength, because those companies can, their PEs can actually go up because the E is understated.
Bob, what do you make of that argument? It's something that a lot of people are saying, that basically you can't have the expectation of rate cuts and the expectation of really good profits. That doesn't match. And actually what we're seeing in the market confirms the strength, because we are pricing out those rate cuts, and that the debt sell-off confirms what we're seeing in equities. How do you respond to that kind of idea?
Well, I think a lot of that is on a backward-looking basis. We had a situation, I mean, it wasn't that long ago, a couple months ago, where there was an expectation of a significant number of cuts going into 24, and even before that, cuts in 23. That was inconsistent with the strength of the economy. I think the issue here is that the continued strength of the economy actually handcuffs the Fed from being responsive to any weakness that they see in early 24 or even through the middle of 24. And so what that means is the Fed is going to hold the course. Even if we start indications of growth softening, even if we start to see equity markets weakening, the Fed knows that on a trailing looking basis, being data dependent, current policy it roughly makes sense. And so when you look at that imbalance of what's more or less likely to happen, it's much less likely that we get the sort of earnings growth that's priced in than we get the Fed pausing for as long as currently priced.
Bob Elliott, Andrew Sliman, both of you are sticking with us, taking a look right now at the stocks moving ahead of the opening bell. Here's Abigail Doolittle. Abby.
Well, Lisa, we are, of course, set here to break a losing streak of 5 days for the S&P 500, the longest since 2022. So let's take a look at what's helping out. RTX, the former Raytheon, surging up 9.1%. They beat profits, $1.25 in earnings was better than estimated. They also announced a $10 billion buyback that investors like a lot. Coinbase Global soaring, this as Bitcoin is above $35,000 per Bitcoin, the highest level since May of 2022, gaining about 16% over the last 2 days alone. And then GE, a very strong quarter there. They blew out both top and bottom line numbers, 82 cents in profits. That's a 46% beat. They beat revenues by 7% for $16.5 billion. And they raised the outlook, surging demand. Analysts very positive here on GE. So some positive industrials that we'll be talking more about the open.
Abby, thank you so much. Coming up, Wall Street weighs in on global headwinds.
We're sitting here with the backdrop, which I think we all acknowledge, of the aftermath of the terrorist attack in Israel and the events that have been unfolding since, and it's desperately sad. So it's hard not to be a little pessimistic given that.
Our team coverage begins next. This is Bloomberg.
We're sitting here with the backdrop, which I think we all acknowledge, of the aftermath of the terrorist attack in Israel and the events that have been unfolding since, and it's desperately sad. So it's hard not to be a little pessimistic given that. It's coping with a world where globalization is becoming more fragmented. The risks associated with globalization are getting more connected together. And how do we manage and navigate that?
A big question. Wall Street chiefs weighing in on the escalating macro headwinds. Israel's military saying it anticipates, quote, long weeks of fighting ahead. But a once widely expected ground invasion now being reconsidered. Hamas continues to hold hostages. The Israeli military dropping flyers across Gaza, offering cash and protection for information on their whereabouts. Over 200 people are still believed to be held by Hamas. Let's get to our team coverage right now. Our fabulous team, Bloomberg's Oliver Cook, joining us from Tel Aviv, and Marie Hordern in Washington, D.C. Ali, let's start with you. What's the latest in Tel Aviv?
Yeah, really, Lisa, it's difficult to say where to start because, again, what's going on in the background here, which is something that has not changed but is still going on permanently, which is the constant bombardment of Gaza, which has been sort of uninterrupted for the last 2 weeks, and that's just always going on sort of in the background. But what is also falling today are these flyers that the Israeli, the IDF is dropping, basically asking for information and on hostages. It's written in Arabic. It has contact numbers saying basically they'll be offering money in exchange for this information, but also safe passage as much as it can be ensured to those who give more information. And that is just the intensifying effort that we know has been underway for the last 2 weeks to get hostages back. We got 2 other ones overnight from Hamas, 2 elderly women. We understand that their husbands in their 80s are still being held. But again, this is just one of the many dimensions here. And you mentioned this sort of ground invasion. And it sounds like, as we've been discussing throughout these mornings, that the form that this is taking may be evolving and that it may be a more prolonged process with a bit more precision rather than the sort of fully anticipated roll in, go door to door kind of ground offensive that many people had anticipated.
And Maria, there's a question around how much the shift in tone from the Israeli government has come as a result of pressure from the United States. The U.S. has been sending more troops over to the region, preparing for withdrawing people from other regions in the Middle East should the conflict escalate. Well, how much pressure is coming from D.C.?
Well, we reported, including myself, along with colleagues last week, that the U.S. and European officials were exerting this pressure on Benjamin Netanyahu and his government to delay this ground invasion, to make sure that these secret talks that the Qataris are facilitating to get more hostages out. Now, potentially it's encouraging. We now have 4 hostages, to Oliver's point, that have been released, even though there are hundreds still missing, and at least we know about 10 Americans missing. So there has been that pressure. And I would also note that we've seen a flurry of diplomacy nonstop in and out of Tel Aviv. Today, we had Emmanuel Macron. He was the latest world leader to go to Tel Aviv, to stand shoulder to shoulder, as he said, with Benjamin Netanyahu. And you see a lot of pressure to make sure they can try to get these hostages out. And when President Biden was asked yesterday about a ceasefire, he says, let's see the hostages first, then we can talk.
Anne Marie, Ali, thank you both so much for giving us the latest lay of the land. Still with us is Andrew Sliman. We've got, of course, also Bob with us as well. And I'm curious, Bob, from your vantage point, how much you're focusing on all of these geopolitical headwinds as a reason to really hide out, Bob Elliott, in the near term in gold and things like that.
Yeah, well, I think most of us have not really experienced a period of heightened geopolitical conflict in our professional careers. And so very few asset managers out there have really navigated these sorts of environments. And I think the thing that you see when you go back through time and study these experiences is the typical 60-40 portfolio is really a type of portfolio that's all in on peace, disinflationary, strong growth. The types of assets that outperform during periods of rising international conflict are commodities and gold. And those are the sorts of assets that are not particularly well held by most investors. And so we're starting to see folks recognize how well gold is performing, particularly relative to bonds in this environment. But given the convexity of gold to this sort of news, it's very easy to see meaningfully greater rises in gold if this sort of conflict starts to heighten even further.
Andrew, your take?
Yeah, I mean, look, the U.S., as it pertains to the world that we traffic in financial assets, the U.S. does not import recessions other than when oil prices have shot very high. So I think as it pertains to the U.S., the key is where is crude going to end up? And in the mid-80s, I think the view by world investors is the U.S. will be the safe haven, and therefore I do think fund flows will flow to U.S. assets as a safety precaution, whether that's dollar, treasuries, or U.S. equities.
What about gold?
I'm not a gold investor. I'm an equity manager. My experience is you sell gold when everyone gets bullish on it, and you buy it when everyone's very bearish on it. It seems like it's getting a lift now. I'd rather be, if I was going to buy a commodity or currency, I'd buy the dollar, not gold.
Just quick final thought, Bob. Do you think that 60-40 then is not going to work in the period that we're heading into?
Well, I think we've basically had, over the last 15 years, the best period of 60-40 that has existed in history. You've had a risk-return profile 60-40 that has been 2 or 3 times better than it's been on average. And so it's time to have investors start to think about what are the other assets that diversify their portfolio. When it comes to rising international conflict, gold and commodities are critical components to protect investors.
And that's certainly what we've seen over the past couple of weeks. Andrew Slimman, Bob Elliott, both of you, thank you so much for spending time with us this morning. Coming up, the morning calls, and later, investors looking to Microsoft and Alphabet to kickstart the rally. That conversation still ahead with Cboe's Mandy Zhu and Colin Sebastian of Baird. Countdown to the Open. I'm Lisa Abramowicz in for Jonathan Ferro. Time now for our morning calls. We'll look at some of the analyst recommendations on Wall Street this morning. First up, MoffettNathanson upgrading DraftKings to buy, noting the company's strengthening profit outlook and expense management. Next up, JP Morgan downgrading Foot Locker to underweight, $17 price target, expecting persistent macro headwinds to weigh on their consumers. And finally, Piper Sandler upgrading American Express to neutral, highlighting the stock's attractive valuation after recent declines. Coming up, big tech earnings kicking off with Microsoft and Alphabet after the closing bell. That conversation up next with Cboe's Mandy Zhu and Colin Sebastian of Baird. Countdown to the Open. I'm Lisa Abramowicz in for Jonathan Ferro. Moments away from the start of trading, you're getting a bit of a lift across the board, up about 0.5% on the S&P, much more on the Russell 2000. Outside of stocks, that is what is allowing stocks to get a little bit of a lift. Yields quiescent, stasis, not going anywhere that quickly. 4.86% rounded up on the 10-year after a really tumultuous session yesterday. Crude just dipping a touch, and real euro weakness on the heels of weaker than expected PMI data out this morning. Something we're watching today in about 15 minutes is the PMIs over here in the U.S. One stock that we're watching at the Open is General Electric, raising its annual profit forecast as rebounding demand for air travel fueled growth in its aerospace business. The CEO saying, quote, "We continue to experience rapid growth driven by robust demand and solid execution. I'm more excited than ever about our path ahead." Sounds like an earnings call. Right now, Bloomberg's Abigail Doolittle joining us with more. Abby.
Indeed, Lisa. GE put up a big beat, but it's not just GE. We're having a day of strength for the industrials overall. Coming into today, the industrial sector about flat on the year. I'm guessing now it's probably higher on the year. Relative to GE, a big beat. They beat earnings by 46%. They beat sales by 6%. And as you mentioned, that strong demand for engines really driving the fact that the company is raising the outlook. CEO Larry Culp, his turnaround plan of multi-year really coming into play here. And he is talking about the aviation operations continuing to experience the rapid growth driven by that robust demand. Now, relative to other industrials, RTX, the former Raytheon, it is having its best days since November of 2020. It is up about 7.4%, also having to do with engines. The loss there was narrower than expected for their engine unit, driving a big beat for the top line, or excuse me, the bottom line. But they also announced a $10 billion buyback, so investors liking that. And 3M rounding out the picture, they also put up a strong quarter as they beat and raised. Some resolution around litigation is seeming to help them. On the year, though, Lisa, it's very interesting because we have 3M bouncing off of an 11-year low. We have RTX surprisingly down 30% on the year after having a big up year last year. But GE up more than 60% on the year. That strength is continuing.
Abby, thanks. From GE to GM, the automaker withdrawing its guidance as a result of the auto strike. I spoke to GM CFO Paul Jacobson earlier today about the decision.
Given that we don't want to speculate where the next plant might be or how long that might be out, we thought the prudent thing to do was to withdraw guidance, despite the fact that the underlying business was actually performing at the top end of our range prior to this. So we'll provide an update with investors as soon as it's over, but we're still focused on making sure that we execute every day.
Katie Greifeld has more. Katie.
Hey, Lisa, yeah, it's unclear what the strikes will mean for GM's full year profit, but the company did say that so far strike costs have reached about $800 million. And going forward, that'll add about $200 million a week in additional costs as this strike continues. Now, that casts a shadow over an otherwise pretty good quarter for GM. The company beat on both profit and revenue. It managed to grow its market share, but Bloomberg Intelligence points out that the fact that they pulled guidance showed that there's still a wide gap here between the companies and UAW in these negotiations. On the bright side, you take a look at the sell side. They don't seem too fussed. Wells Fargo says that the guidance withdrawal, not too surprising given the strike, and RBC actually expects the stock could climb from here given that the strike impact may already be priced in. But in any case, you look at shares right now, currently off by about 1.4%.
Katie, thank you so much. Sticking with earnings, Coca-Cola boosting its full-year outlook despite raising prices and other macro headwinds facing consumers. The CEO saying, quote, "Our leading portfolio of brands positions us to win in the marketplace today, while laying the groundwork for the long term as well." Joining us now, Bloomberg's Simone Foxman. Simone.
Yeah, Lisa, consumers aren't buying a lot more Coca-Cola products, but they are willing, it seems, to pay more for them. That meaning the company able to boost its full-year outlook for 2023 on a revenue growth terms to 10 to 11%. They had seen 8 to 9%. Analysts had expected it to be a little higher than that range, around 9.9%. The company also saying that profits will grow at 7 to 8%, up from 5 to 6%. But the company does see a little larger foreign exchange headwind than they had anticipated at 6%. We also saw some beats in the third quarter earnings, with EPS coming in at 74 cents rather than the 69 cents that were estimated. But the real focus is price mix. As I mentioned earlier, like Procter & Gamble, which we heard from in the last couple of weeks, they appear able to pass on these price increases despite some of these concerns about the health of the consumer. We did see some pressure on volumes. Globally, volume was up about 2%, flat in North America, but contrast this to Pepsi, which is also expecting revenue growth of 10%. It is, of course, Coca-Cola's chief rival, but that company has seen volume decline, especially in North America, seeing a decline of about 6%. The earnings call going on right now, CEO James Quincy saying that the European consumer, in fact, is under slightly more pressure than the U.S. consumer. They are trading down more. We will see if that earnings strength continues, but you're watching shares react in a positive fashion to this news from Coca-Cola this morning, Lisa.
Simone Foxman, thank you so much. And finally, shares of Spotify moving higher after earnings, swinging to a quarterly profit after raising prices within its streaming service and posting better than expected user growth across all regions. The company rating, quote, "We're pleased with our Q3 performance and view the business as well positioned to drive continued progress." All of these commentaries of optimism that we keep hearing from the CEOs. Bloomberg's Ed Ludlow has more. Ed.
Yeah, good morning, Lisa. This is an interesting or odd one because when the numbers dropped, Spotify was trading lower
for most of the pre-market session. The market's open. We're currently up almost 7.5%. That puts Spotify on track for its biggest jump since the end of January, and a gain of more than 11% would put it on track to trade at its highest level since July. So this is a pretty big response. Strange, though, given the negative response in pre-market when the numbers hit. Top and bottom line beat. A big part of that is the impact of them raising prices earlier in the year. They had a surprise operating profit which came with it. But you look at the subscribers, right? We're still learning that whether it's an audio video related platform, you kind of live or die by your subscriber count. In the quarter, premium subscribers rose 16% to 226 million, slightly above estimates. But then you go to the fourth quarter forecast, and overall active users, both premium subscribers and non-premium, Spotify is forecasting 601 million active users for the fourth quarter, with 235 of those being premium, above expectations. So the impact here of higher prices is working on the bottom line. They're continuing to grow, and also having cut jobs and pulled back some investments and green lights on podcast projects, there is emphasis and evidence that the podcast business is going well, up 8%. And as I said, Spotify on track for its biggest jump since January 31st of this year.
Ed, thank you so much for that. Those are just four of the many earnings movers this morning. We're seeing a whole host of others, including Verizon. And of course, after the bell, Alphabet and Microsoft today, Meta tomorrow, Intel and Amazon on Thursday. More than $15 trillion of market cap are reporting today. Baird's Colin Sebastian writing, quote, Q3 earnings should generally be in line. We maintain estimates somewhat below consensus for Q4 and 2024, given signs of more fragile consumer spending. Joining us now, Colin Sebastian. Colin, thank you so much. I'm curious just how high the bar is for the likes of Google, like a Microsoft, given how much the shares have run up so far this year.
Yeah, thanks, Lisa, and good morning. So, I mean, we have seen this resurgence of big tech for the year to date that really shows the underlying strength, the structural advantages that platforms like Alphabet have. And quite frankly, what moves the needle for these companies is still fundamentally consumer spending. And with the strong job market, with strong levels of consumer spending, search advertising for Google has been resilient. YouTube has accelerated in growth. And of course, a lot of attention on AI and the cloud platform. And we'll get an update on that here in a few hours.
Well, that's exactly where I wanted to go, Colin. How important is it for them to be monetizing the AI technology at this point versus laying the groundwork for just broader adoption?
Well, there are a lot of services for both individuals and businesses that can take advantage of a lot of this transformation, but it takes time. And so, as you say, there's a lot of laying of the groundwork right now, and that comes with cost as well. So we're keeping a pretty close eye on the expense structure. But at the same time, the cloud transition is still happening. Companies are moving workloads, and while there's a little bit of cost optimization happening, we still expect well in excess of 20% growth for Google Cloud Platform.
Who do you think is the most underpriced of the big tech names when it comes to AI adoption?
Well, I think Microsoft obviously is benefiting from a tremendous amount of hype related to its partnership with OpenAI. And ChatGPT obviously opened everyone's eyes to the potential of generative AI. So in that context, Google and Amazon probably have received less of the hype, the benefit of that hype. Amazon in particular has traded off over concerns around AWS and growth in the last month or two. So I'd say perhaps expectations are a little bit below where we think they should be for Amazon, but Google as well. They are extremely well positioned in AI. They are the AI company, and we think they'll do very well with this transition.
I have to ask this because everyone this morning has been bringing it up. Do bond yields matter to these companies that don't need to borrow? Is this basically the area that is independent to what we're seeing in borrowing costs just simply because they are cash cows?
Yeah, I mean, that is certainly part of the dynamic. These companies have significant cash balances. They're earning more on that cash. But we can't ignore the ripple effect that higher rates have through the economy. Ultimately, Google, for example, is the world's largest media company. So they can't avoid the cycle. They can't avoid whatever happens to their end market, to businesses and consumers. So we'll be very closely paying attention to what they say today about what their seeing on the macro front with their customers and if there's any pullback in ad spend or activity with consumers.
Colin Sebastian, thank you so much for being with us. Cboe's Mandy Zhu weighing in on upcoming results, saying, quote, investors are focused on the fundamental drivers for stocks, earnings, and higher rates, while looking past macro risks, such as risking rising geopolitical tensions in the Middle East. Mandy joining us now. Mandy, you are the person that I want to talk to. Stocks have been almost havens relative to bonds recently. Can that persist?
That's a great question. And I think what's really interesting to point out is that the way that equity investors have been positioning for higher rates and adjusting to the higher for longer rates regime is really through stock selection and sector rotation, not through macro or index plays. And that's why if you look at the run-up in volatility that we have seen over the past few weeks, it's actually really led by single stocks, not the index. So if you look at the correlation of the stocks in the S&P, that's still remarkably low and is still within the same range that we saw over the summer.
So at this point, as you take a look at earnings, are stocks and implied stock volatility increasing in response to some of the earnings, or really is it just highlighting what a staple it sort of has been as companies look to just general strength and a generally benign backdrop?
Yeah, so I would say if you look at what's been going on for the past 2 weeks, I would attribute most of that to kind of upcoming earnings and pricing in more earnings risk, and actually average single stock volatility. It's near a year-to-date high, on par with what we saw in March during the SVB crisis. But if you take a step back and look over the past 18 months, what's been even more remarkable is that single stock volatility and the dispersion of stocks that we've seen in the S&P has been really on par with what we saw in 2020. So if you look at the dispersion of stocks in the S&P 500, which you can track by the DSPX index, the average levels over the past 18 months is what we saw in 2020 when the VIX was at 90, right? So that tells you, even though index volatility has declined, we're still continuing to see a lot of rotation, a lot of movement underneath the index surface within these sectors and within the stocks themselves.
What's the main driver, Mandy? Is it really just the macro factors and some of the yield moves, or is this the drivers of the volatility in the specific stocks just directly tied to earnings and the lack of visibility that individual traders have at any given day on what companies are seeing?
To me, I think the primary driver, if you look again at the past 18 months, it has to be higher rates and kind of the incredible sector rotations and the swings in leadership we've seen, right, from growth to value, back to growth. You know, we've seen kind of old economy stocks rally last year, and this year it's all about tech, right? Tech down 40 last year, up 40 this year. So that those incredible swings that you're seeing at the sector and the single stock level, I think that is what is driving the volatility in the market right now is not at the index level. So correlations that actually near historic lows. And historically, what happens is correlation tend to rise when people start pricing in more recession risk. So that's going to be the big question going forward is, are we at the end of the economic cycle? Could we really start to see things turn? And until it does, when it does, I do expect, index volatility to start dominate on the back of higher correlation. But until then, the way that investors have been really playing for higher rates is through more the index, through more sector and single stocks.
Mandy, I love that we get to speak to you because Tom usually busts my chops when he talks about the VIX, and he says you can be gloomy and doomy, but look at the VIX, it's doing nothing. Has the VIX essentially broken as an indicator of forward-looking volatility?
So I would argue no, and not just because I work for the CBOE. I think a lot of people have been puzzled by the decline in the VIX over the past year. But if you look across asset classes, the decline in equity volatility is on par and in sync with declines that we've seen across currency markets, across commodity markets, across credit markets. So that tells me, again, what's driving volatility lower across every asset class is the macro picture, right? The fact that we've gone from everyone talking about recession to now the consensus view being soft landing. That is the reason why volatility is low, not because of zero-day option, not because of any equity-specific factors. It's really the fundamental picture of the economy has turned more constructive over the past year.
Mandy Zhu, thank you so much for being with us. We really appreciate it. Meanwhile, some fresh U.S. economic data crossing the terminal. Abby Doolittle has more. Abigail.
Well, Lisa, it is coming in better than expected. We're looking at the S&P global PMIs, both for manufacturing services and overall. The preliminary reading for October, and we're looking at 50. That, of course, is the dividing line between contraction and expansion. So we are slightly in expansion territory. The manufacturing PMI came in just at 50, slightly above. Services 50.9, also above. Overall 51 above the survey of 50, so a little bit more in line with some of the data that we're coming out of ISM next week. And these, of course, are smaller to medium-sized businesses relative to the ISM that are larger. But again, the economy a little bit more in expansionary territory. It'll be interesting to see whether or not this factors into the Fed decision next week, Lisa.
Abby, thank you so much. Coming up, House Republicans trying to nominate a speaker candidate again.
I think the fact that we don't have a Speaker of the House right now is very concerning. I think it's concerning the Republican conference right now.
We'll discuss the state of play in Washington, D.C. That's next. In the meantime, you are seeing dollar strength, euro weakness on the heels of that PMI data. This is Bloomberg.
I think the fact that we don't have a Speaker of the House right now is very concerning. I think it's concerning the Republican conference right now. I really think that over the next 3 to 4 weeks, there are going to be so many shifting dynamics internationally and potentially domestically that is going to force the hand of the Republicans in the House to really get it together and move forward with a Speaker.
House Republicans currently meeting to select a nominee for Speaker from a pool of now 8 contenders. The previous 2 candidates failed to secure enough support to win the job. Tom Emmer of Minnesota emerging as a possible frontrunner. No candidate is viewed as having a firm hold of the party's majority. Multiple rounds of voting expected today behind closed doors before the floor is scheduled to convene at 11 a.m. Eastern and maybe come to some sort of decision. Joining us now, Kayleigh Lyons and Anne-Marie Hordern in Washington, D.C. Anne-Marie, I want to start with you. What's the latest? What's the likelihood of us actually having a speaker, not only by the end of today, but the end of this week?
I think that maybe is a big maybe, Lisa, when you're talking about the potential that we could see a floor vote today, and that individual that after this closed door meeting, which will see Republicans voting, it might be a couple of ballots till they decide who the majority is, and that person will be the nominee. But when they go to the floor, can that person actually get 217? Maybe the fourth time's a charm. We went through Kevin McCarthy. We went through Steve Scalise. He didn't even get a floor vote. And then we went through Jim Jordan. Potentially, can Tom Emmer become that person? We also should note Byron Donalds left yesterday. He has some support as well within the conference. He said he's going to be up all night making a lot of calls. And then, of course, there's Kevin Hern, who said, I didn't come here to be second or to lose. So there are other individuals that we could see, even though at this moment it does look like Tom Emmer, who's third in the leadership. He's the majority whip. He has a lot of relationships, close relationships with his colleagues. It does look like he's the front runner, but that question remains. Can he get to 217 on the floor?
Kayleigh, where are the Democrats in this, considering there was some discussion about possibly working together for some sort of bipartisan solution?
Yeah, Lisa, when we talk about the effort to get to 217, that's assuming everyone shows up for the floor vote, and you require 217 Republicans to actually get the gavel. There is, though, a possibility that because Emmer is a little bit more tolerable to Democrats, theoretically, at least on the margin, because he did vote to certify the results of the 2020 election, that they could help him out by not showing up for the vote, by sitting it out. That is something that was raised by Democratic Congressman Dean Phillips of Minnesota earlier. He just posted on X this morning that the dysfunction in the House is a national and global security issue, going on to say, I would sit out the speaker vote if Tom Emmer will fund our government at negotiated levels, bring Ukraine and Israel aid bills to the floor, and commit to rules changes to make Congress work for the people. So that's one possibility. But of course, if Emmer can't even secure the simple majority behind closed doors to get the gavel, if it still looks like the House Republican Conference is deadlocked, then we could see a revival of the conversations of Democrats working with a handful of Republicans to elevate the powers of Speaker Pro Tem Patrick McHenry, at least for an interim period of time, while the House tries to sort this out, Lisa.
Kayleigh and Marie, both of you, thank you so much. We will be covering this, I'm sure, again with you both again soon. Coming up, the market-moving events that you need to be watching. That's next in our trading diary. In markets, after that PMI data from the U.S., you could see euro weakness, continuing dollar strength. This is Bloomberg. Time now for the trading diary. We need to be watching this week. House Republicans meeting this morning as they try again to nominate a speaker candidate. Big tech earnings ramping up with Alphabet and Microsoft after the closing bell. We get Meta results on Wednesday, followed by Amazon on Thursday. And finally, also on Thursday, we get an ECB rate decision and U.S. GDP figures. That ECB rate decision particularly fraught after what we saw earlier this morning with PMIs out of Europe coming in disappointing, the opposite of what the U.S. just reported, with actually PMIs that exceeded expectations. If you take a look at the euro, it is being expressed dipping below 106 at one point. In the equity space, holding on to gains about 0.6%. Half an hour into the open. This was Countdown to the Open. This is Bloomberg.